Hi everyone, and welcome to another video for John and Jane's retirement accounts. I apologize for the delay. I had mentioned that my goal was to get caught up on these videos, and then my wife had an unexpected C-section. She developed a case of preeclampsia, and that really created quite the chaos for the last week and a half. So good news is that my baby boy and wife are both healthy. Baby boy is in the NICU, so we've been spending a considerable amount of time and energy going back and forth between that, and then also me driving her down there every day, and then continuing to go to my normal job so that I can actually spend time with him when he gets back home, instead of spending time in the NICU where I'm not really of any great use. So I spend the weekends down there and after work with him, but yeah, it's really taken a hit on my energy levels and ability to do these videos. So without further ado, let's get into it and see if I can actually manage to get caught up from here without any additional life events taking place. So anyway, thanks for all of your patience. So, as always, I am not a financial advisor. I don't claim to be one, and I highly recommend you do your own research, and that these videos do not reflect the views or opinions of my employer. I do hold a number of positions similar to what Jane has in her portfolio, and I always like to emphasize that this is a real portfolio with actual shares being traded. So it is not a practice portfolio. This is not play money. For the lack of a better term. So the reason why I do this is because John and Jane a few years ago were being taken advantage of, in my personal opinion, and the results that they were getting from their portfolio were not anything better than what they could have achieved on their own. So we talked about it and decided that instead of paying a financial advisor, that they wanted to take control of things on their own and have more control over what they invested in, but also what kind of fees they paid. And in this case, because I do this purely because I want to see them succeed and do well, then there is very minimal fees, especially now that trading fees aren't even a thing to take into consideration anymore. So. But that's one of the big motivations behind why I do this. So, John and Jane with their background. So, I always like to give the background of both, because even though we're looking at Jane's portfolio, I think it's important to at least get an understanding of where they stand as a whole. So, John retired in 2018, collects Social Security. Jane retired in 2021 and has also begun collecting Social Security. But has not been withdrawing any money from her retirement accounts yet. So John and Jane do pull about $1,700 a month from their taxable account, which can be seen in my other videos, and then $1,000 a month come from John's retirement portfolio, specifically out of the traditional IRA. They do have other investments outside of what I help with, and these investments primarily consist of minimal risk bonds and certificates at local financial institutions. And then as far as debts go, John and Jane have no debt, so no monthly car payments, no housing expenses. Basically, property taxes, water, power, things like that are the only actual monthly expenses that they have. So in this article, it's going to take me forever to get over saying that, but in this video, their account, they generated just under $2,300 of dividend and interest income in September of 2023, and that compares to just over $2,300 of dividend and interest income in September of 2022. And then in the Roth IRA, there's just over $800 of dividend and interest income, compared with $660 of dividend and interest income in September of 2022. So I will be going over some of the reasons why we saw a reduction in income. Nothing that from the traditional IRA. Nothing substantial, but there are a lot of moving parts right now, especially with the increase of cash on hand that we'll be looking at. And then also with the traditional IRA, the balance is actually up substantially at about 411,000 compared with 375,000 for the same time last year. And then for the Roth IRA, it's up decently, about $8,000, so at $193,000 compared with $185,000 same time last year. A total of 6 companies in Jane's retirement portfolio paid increased dividends or issued a special dividend during the month of September, and no companies decreased their dividend payouts in Jane's account. So of the 6 companies that raised their dividends or paid a special, or in this case what we would call a supplemental dividend, there's a total of 6. First being Bank of America, increased by 4.8%, BP increased by 10%, Cummins increased by 7%, Main Street Capital issued a supplemental dividend of 27.5 cents per share. Owl Rock Capital issued a supplemental dividend of 7 cents per share. And then PPG increased the dividend by 4.8%. So one of the things is that with Cummins, we recently cut that back to a pretty minimal size position in the Jane's retirement accounts. And the main reason being is that we're just looking for a better entry point. So we took some of our gains, set it aside, and the other big reason for us doing that is that Cummins' yield that it has at this point is quite a bit less attractive than what we can get from a certificate of deposit. So from the standpoint, hoping that Cummins' stock price will increase, that's just not a scenario that I think is a great bet at this point in time. And so that money seemed to be better set aside in a certificate of or some safer fixed income investment rather than being left in Cummins. Now, again, that doesn't mean that we're not going to reinvest in Cummins. We're just looking for a better entry point so that we can maximize that dividend yield, because as the stock price goes down, dividend yield goes up, and then that also helps us increase the opportunity for upside gains as far as the capital appreciation. And then as far as the BDCs, so business development companies, that's going to be Main Street Capital and Owl Rock Capital. Both have been issuing supplemental dividends. Main Street, for a very long time, they've been doing this. Owl Rock Capital just started doing it. But the benefit here is that because of all of the net interest income that they've had due to rising interest rates, they're now passing that on to shareholders. And the main reason why is because to qualify for a business development company, you need to distribute 90% of your net income to your shareholders in order to get favorable tax status. So to qualify as a business development company, that is something that is mandatory. So as their net interest income goes up, that just means they have more money sitting on their books that they need to potentially do something with. And in this case, returning it to shareholders is a very common thing for these companies to do. So I wanted to show what each of the 6 companies look like in terms of the lots, and you can see that with Bank of America it goes back quite a ways, and that the cost per share, we do have some at extremely low cost per share. So this was done back obviously right during the beginning phases of COVID, and then now we do have some at a little bit higher cost per share, but nothing that is too concerning. I still think it's an appropriate value for the stock. So if the stock price drops down below about 25 a share, that's when you're going to find that I'm going to be more interested in purchasing again. And then for a BP here, this one I am definitely getting a little bit more interested in pulling the trigger on. BP has turned quite the corner in terms of its dividend, and and just its earnings and the way that the company is operating. But I am still looking to reduce these higher cost share positions, specifically the ones over $40 a share here, because if you take a look at BP's chart, 40 is a pretty strong resistance point in terms of whether or not the stock price is really going to be pushing that level anytime soon. So as it drops down, with it being in the $35 share range, it's definitely on my radar to be able to pick up more of those shares, and then to be able to sell these later on, even if we have to end up selling these at a little bit of a loss, in order to reduce the cost basis of that position. And then for Cummins, as I mentioned, so we still hold quite a few shares in the taxable account, because that's where we choose to continue holding shares simply for tax purposes. But as far as the traditional IRA goes, this is something that I'm willing to take those gains off the table. So then that way we can invest in something else that's going to produce more income, but also that we have cash on hand to be able to capitalize when the stock price inevitably comes down, because I think the stock price is just too high right now, given the shaky grounds that the economy is currently resting on. And then for Main Street Capital, we hold in both the traditional IRA and then the Roth IRA. So the first image here is going to be the Roth IRA cost basis. And then this one over here is going to, on the right, is going to end up being the traditional IRA cost basis. So you can see that we're sitting at a pretty good position. The thing about Main Street Capital is I think it's an excellent business development corporation. Anytime it's dropping into the about mid $30 share range, you can bet that I'm willing to be a buyer again. But I'm a little bit hesitant to buy over that, simply from the perspective that I'd say about $42 is really a cap on where the price of the stock would be going. So unless something happens, I don't see that stock price pushing much higher anytime soon. And so frankly, until it drops below 35, there's not really much of an interest to be able to buy it. Now, if it pushed 42 again, I might consider selling some of these higher cost shares, like this, for example, at the 39, where we previously had bought a little bit too high, but honestly, at this point, there's really not much that I'm willing to change when it comes to the Main Street Capital position. And then Al Rock, you can see that we've continued to steadily add to the position. Again, it's been performing quite well. Everything looks great with it, and it continues to increase its dividend as the interest income continues to roll in. And then for PP&G, this one we've been trading in and out of a little bit more often. You can see right now we're sitting close to about a break even, and yeah, we are looking for shares to continue dropping, if possible. Not necessarily that I'm expecting them to, but right now it's sitting about the 128, so about the same price as when this screenshot was taken. So if it does drop further, then we'll look at adding more shares in the 120 range here. But as it moves back up again, if it does, once it gets into about the mid $130 share range, we'd look at selling off some of these that are sitting at that level or a little bit higher. I guess the upper end of the $130 share range, just to reduce the cost basis of that position. And then for the trades, there's a lot going on in the month of September. So we had mentioned in previous articles, General Mills, in this case Cummins, and you can see that we sold it at a pretty favorable price compared to where that stock price is currently sitting at today, which by the way is sitting just over $219 a share. So we sold this at a pretty good time. Also selling off quite a bit of our Canadian stocks. So in this case, this is the outright elimination of the position of Canadian Imperial Bank of Commerce. It's been a long time underperformer. And even though it continues to raise its dividends, the amount of mortgage exposure that it has is just something that I'm not interested in at the moment in comparison to much safer alternatives. So, and then as far as Broadcom goes, we still hold the position in the Roth IRA. But we eliminated it here, and again, that mainly had to do with where the stock price is at currently, and us being able to take those funds and invest it in something that's going to produce steady income, and also at a very comparable or higher level, I should say, than what Broadcom currently offers. So, bought the CD here from Wells Fargo, so that one's at just under 5.5%. And is going to be good for, I believe that one's about 18 months in total. And then with Eaton Corporation, same thing. This thing has been, as Cummins, this thing's been kind of a high flyer. And even though the stock price is currently back over where it was, I don't personally see the justification in continuing to hold this position when I think that there's just too much downside that exists. We still have a position in Eaton, and we'll continue to buy it if it drops back down to more reasonable levels. And then for LyondellBasell, you can see that we sold off shares at 102. Part of the reason for doing that was that we were getting rid of the high cost basis shares as usual. But now you also see that shares have dropped down to just under $94 a share. So at $102, that was about the peak of where the stock price hit. So it was a limit trade that was set, and it was the best opportunity for us to reduce the higher cost position of that and free up more capital to be invested. And then for Williams Companies, this one we were getting rid of the high cost shares. Again, no surprise there. But we still maintain a very large position in Williams Companies. And then for Royal Bank of Canada, we reduced the size of that position. And then for AbbVie, we had mentioned that we had eliminated that altogether. Pharmaceutical companies are not something that I'm particularly fond of. And the big thing there is that we would rather invest in BME, and that is going to be the BlackRock Health Sciences Trust. And so that's going to be a way of producing consistent income, but also having some exposure to the medical and pharmaceutical fields without having to do the kind of research or understand the way that those companies work, because it's just a whole new animal, in my opinion, when compared to many of these industrial manufacturing companies. There's just a lot more the FDA's involvement, legislative involvement. It's too, there's too much uncertainty even when you have a large company like AbbVie. All right, and then for the Roth IRA, you can see here where we continued to add more shares of NextEra Energy. We added Goldman Sachs at 5.55% on a 24-month CD. And then for Broadcom, we had sold off part of the position here, retaining the other half of the shares. And then as for RNP, we purchased another block of that. We did sell off Gaslog Partners. This resulted in a small gain, and frankly, for the income that was being generated from it, there's safer alternatives without having to have the exposure. And then, as mentioned previously, the sale of some shares of Toronto Dominion Bank, and that again goes back to my issues currently with the Canadian banking system. So for September, this is looking at what the realized gain loss was. A lot of this is going to come from the sale of Broadcom. That's going to be a little under half of where these gains are from, because those shares were at a very low cost basis. But because we are in a tax sheltered account, none of this counts against John and Jane's taxable income. So for the month, we can see that it's at a great net gain of just under $20,000 after the losses. But you can see that we sold off quite a few shares of positions at $60,000, at $41,000 was the original cost basis, and then the proceeds were just over $60,000. And then for the Roth IRA, on this one I included the additional piece here of the realized gains loss. I couldn't do it on the other one because of how long that list is. And in this case, you can see that the cost basis was about $8,300, and the total proceeds came out to be just under $15,000. So in this case, it was the sale of Broadcom that was a big component of that. I mentioned that with GasLog, that there was a gain loss that was negligible. And then also the Toronto Dominion, there was a gain that was also fairly negligible, at least in comparison to Broadcom. And then looking at these for the year, I went ahead and I took new screenshots through the 9th of November. And so for the traditional IRA, you can see that we've sold off a cost basis of just over $110,000 out of the portfolio, and then that's resulted in proceeds of $140,000. So we're looking at about $30,000, at least just shy of $30,000 worth of gains that have been logged from the traditional IRA so far in 2023. And then when looking at the Roth IRA, it's quite a bit less, but still a substantial amount of proceeds that have been generated at $55,000, with the total cost basis being about $41,500. So the net gain that we're looking at on this is going to be about $13,700. So that's also looking good, and honestly pretty indicative of just how much capital has been recycled through Jane's retirement portfolios in 2023. And then as far as the September comparison here, reduction of positions size when it comes to Archer Daniels Midland, Broadcom, Cummins, Digital Realty, and then Williams companies. That I would say is a big contributor, but also we saw the elimination of IBM and the Annaly Real Estate Investment Trust. Their preferred Series G was also eliminated. We had the elimination in the dividend for Lumen. So previously it had been collected in 2022, but it was canceled, or at least eliminated shortly after that. And so in 2023, there has been no dividend collected for Lumen. And then for the 2023, the upside piece is that now we're finally starting to see the money market and CD income rolling in. And so as we add more CDs, we can expect that the consistency from this, which all of the CDs that I select pay monthly, so we'll be seeing that on a consistent basis starting to come through, and make up for some of these companies that where the positions have been reduced, and the amount of dividend being paid has been reduced. So for the Roth IRA, the biggest notable change was the elimination of Broadcom, but we have had a substantial increase in the size of RNP, and RNP is the real estate investment trust. I apologize, a Cohen and Steers real estate investment trust and preferred income fund. So looking to buy more into that, especially as the prices come down, making it a good opportunity for some capital gains, but also to lock in the above average dividend yield. And then also we added in Suncor to the portfolio, and then it hasn't reported yet, but the CD income should be generating for the month of November. It might actually possibly be there for the month of October. I have not checked yet, but if not, it'll definitely be there in the month of November. Now that we'll be having a CD income being generated there as well. So the Roth IRA is doing quite well year over year. And then the full year-over-year comparison, we can see that the estimated income for the traditional IRA is up 9%, which is good because it was estimated to be 8.2% in the month of August. So the amount, even though it was slightly less than 2022, it is still higher than what we had originally estimated. So that is a big positive. And then as far as the Roth IRA goes, we can see that that one took another good jump again, going up from 2.5% to 3.7% in terms of the increase year over year of total income. And on the account balances, I'd mentioned on here that the traditional IRA right now is about $36,000 over the same point in 2022. And then also the Roth IRA is up $8,000 year over year. But one thing I do want to point out is that you'll notice that the month of September was a huge hit when you look at the traditional and Roth IRAs. So even though these numbers look positive here, September was a very rough month in the stock market in 2022. So when I look at these account balances this much higher, I take all of it with a grain of salt, because it very well could rebound quickly in a way that eliminates or reduces what looks like such great preservation of account balances. And then as far as the 6-year traditional income comparison, you can see the steady increase over time, and everything looks great with that. So even during COVID, even during the lockdowns, we can see that so far 2023 looks to be potentially the lowest increase year over year. But if we continue to see more income come out of it, it is possible that we will see it hit double digits. Which would be awesome, because then that would be 6 years technically 5 full years of double-digit income increases year over year. And then as far as the Roth IRA goes, you can see a little bit more of a sporadic increase here. With what we saw in 2019, 2020 was still saw an increase, but was a pretty big reduction. And then we saw 20% and then 30% in 2022. And right now we're sitting at the 3.7%. And so with that dividend income, the interest income coming in from the CD, it is possible that this will push higher, but I'm expecting it to be higher than the 4.5%, but I'm still expecting it to remain in the single-digit range as far as the increase year over year. And then for the cash balance comparison, you can see where all of these sales generated a significant amount of cash on hand. Remember that this is a snapshot in time that was taken at the end of the month of September. So these numbers have changed quite substantially, including because we used the funds to be able to purchase certificates of deposit. So in these cash balances, it does not reflect certificates of deposit, and there is currently $85,000 in the traditional IRA in these instruments, and another $15,000 in the Roth IRA. So in Jane's retirement account, she currently has $100,000 invested of her money into fixed income investments, such as the money markets and the certificates of deposit. And then for the unrealized gain loss, we can see that we have gotten to the point where it is now logging a loss for the month of September for both the traditional and the Roth IRAs. One thing I do want to point out that was mentioned on the previous slides is that because we've been selling so much, a lot of the gains that we've been taking, if we took, in this case, the $30,000 worth of gains and added it back into the traditional IRA here, we would be still sitting at potentially an unrealized gain loss that is closer to $15,000 in the positive. And then as far as the Roth goes, that one would also be in the positive. So it's not so much that I'm concerned that these numbers are now in the negative, it's just understanding what is part of what's causing that to happen. And then as far as the current gain loss comparison goes, these numbers are going to be different here. So this $28,000 number at the bottom here, I want to point out that this number is going to be accurate as of November 2nd, which is when these numbers were updated. And so as you can see, that gain loss has increased, I guess, yes, it has increased in loss. So the concern is that we're going to see more of these stocks continue to move negatively. We see 3M, we see Lumen, some of these big, what looks like big losers. But the thing is that this number is going to continue to fluctuate. If we were to pull the numbers after the rally the markets had over the last few days, this number is going to be actually quite a bit lower. And so the thing is for me is that that's the number that I pay the least amount of attention to. And for me, it's really more about building up a portfolio that's going to produce the sustainable income. And if I'm concerned about its ability to pay that consistent dividend and to have those increases, then that's when it becomes something that's more of a concern for me in terms of how I eliminate or at minimum reduce its exposure in the portfolio. And then for the Roth IRA, you can see here, same exact thing where the losses are currently sitting higher than what they were on that previous slide. And again, that's because this is a more recent update from that. But the current yield on that portfolio is sitting at about 5.6%. And then as far as the performance, all the companies continue to raise their dividends, and just like shown on the previous slides, everything looks good in terms of the performance here, at least in the short to medium term. All right, so for the conclusion, and sorry, this has been a lot of work simply because I'm so tired, so I apologize. I'm trying to not ramble, but the same theme has continued to apply. Cash balances have increased substantially, and the reduction or elimination of certain positions that no longer present a compelling risk reward is basically part of our strategy, that we are reducing or eliminating those positions when it doesn't make sense, and then we are investing in things that do make sense. And in this case, the things that make sense are things that are able to protect or preserve capital, and then also produce or generate the income that's needed for John and Jane to be able to live a comfortable retirement on. So, the current gain loss tables, those are going to also reflect any sales or trades that were made in the month of October, which is why it's quite a bit different than what you see for the Excel tables where I'm tracking it at the end of the month, and in this case, this article being the end of September. So just remember that those final two ones that I say are the most important ones, that those are based off of numbers that are primarily from October, and in this case, specifically from November 2nd. But that's why I'm trying to get these articles caught up so that there isn't this huge 1 month delay over time. So, and if you have any questions about these, please feel free to ask. Like I said, I'm trying to not ramble, but I know that this can be a lot of information to take in a short period of time. So, for all those who are newer to the articles or the videos, it's always great to point out tax deferred accounts like IRAs have no impact. So when it comes to selling something, I am more willing, like in this example, selling Cummins out of the Jane's retirement account as compared to selling Cummins off the taxable account. There's more consequences for selling out of the taxable account than there is for selling out of the Jane's retirement account. So that is something that does get weighed in my decision, and part of the reason why on the taxable account we try to buy shares of companies that we are going to hold for very long periods of time, because our goal is to not have to sell unless it really makes sense, and in this case it's primarily to reallocate capital. But for the stocks, this one kind of, the fourth bullet point is kind of a continuation of the first bullet point, because the stocks that have kind of underwhelming prospects for price appreciation and dividend growth are the candidates that are at the front of the list for being sold and then put into higher yield money markets, certificates of deposit, or even treasuries or bonds. So that's kind of the basis of our strategy. But if there are any questions, please feel free to let me know in the comments. Again, I apologize, but I'm sure that everyone can understand that my wife and son definitely take priority. So my goal is to continue getting caught up on these videos, so hopefully I can get another the final one for the September done, and then start working on the ones for October. That way the ones for October are done by the time December rolls around, and then we can hop right into the November articles. So anyway, thanks for taking the time to watch, and I appreciate everyone, and have a great day, and happy Thanksgiving to everyone.